I'm just going live.
Sure.
All right, so we have 8 attendees with us. Hello and a very warm welcome to all of you. My name is Anisha and I'll be your MC for the day. Welcome to the Adyogi Getvantage masterclass. We will talk about fundraising in the new normal. We'll start off in a bit, but before we start off, to all the attendees over here, we would love to know your business. So if you're a small business owner, if you're an enterprise business owner, feel free to pitch your business in the chat box below. We'd love to see your products. We'd love to see your Instagram handles. We'd love to explore your D2C websites. And that being said, we'll start off in another 2 minutes. Thanks, Kumar Jayant, for letting us know. We'd love it if you also let us know what your business is about. Feel free to drop the link of your website here. All right, so we'll get started now. Hello and a very warm welcome to all of you once again. My name is Anisha and I'll be your MC for the day. A very warm welcome to the GetVantage Adyogi Masterclass. Here we are talking about fundraising in the new normal. We'll understand about the 5 Ys and 5 Ws and 1 H of how sustainable fundraising happens in our ever evolving scenario. To talk about the same, we have Sneha from the GetVantage team. A very warm welcome to you, Sneha. Over to you. We'd love to know more from you. Feel free to introduce yourself to us first, and then we can get started.
Sure. Thank you, Anisha, for that warm welcome. And thank you, everyone who's here participating in this masterclass here today. I'm your speaker for today. I'm Sneha, and I look after growth and partnership here at GetVantage. My background has primarily been in finance and healthcare. And I've always been in a startup environment. So great audience to have here. In my first role, which was MNC, which was looking to launch its operations in India, which is Equifax. They were looking to set up their India operations back in 2008, 2009. And I was part of the founding team based out of India over here, where we were set up to get the license and launch the credit bureau. If you guys have ever, had your company get a credit score or get your individual credit score, that's what an Equifax would do. My role over there was to get banks, such as public sector banks, private sector banks, cooperative banks, housing finance companies, NBFCs, to be a part of the bureau and to start sharing data and using credit bureau ratings and to evaluate their potential customers. In post that, along with a colleague of mine, I went on to set up SME Corner, which, as the name suggests, is an enterprise to help small and medium-sized businesses get access to debt instruments. It was one of the very first digital aggregators for loans, and it is an NBFC today and has raised a couple of rounds of capital. In my latest and most recent avatar, associated with Wealthy Therapeutics and looked after a large part of their regulatory and compliance, where It involved ISO certifications, and in order to step into foreign territories such as the European markets, to look after their CE and HIPAA compliance, which is to do with data privacy and know your customer information. So very relevant even from a financial standpoint, like a company such as ours at GetVantage, where customer information is super sensitive and stored and as a repository with us, how to handle that customer information, how to protect it, how to share it, depending on the nature of the partner, etc. It's very relevant in that context. And like I mentioned here, I look after growth and partnerships. And one such partner that we're doing a masterclass with today is Adyogi. So thank you for having me. Jumping right into our subject today, which is fundraising in the new normal. And let's just understand what's happening today and what are the trends that we are seeing. So just a brief overview and takeaways from what we're going to learn today or see today is also just the flow of the session that I'm going to conduct. What is the new normal? And before I dive into the different modes of fundraising that are available, I will take a step back to see the ecosystem and how it is evolving, and to see the different needs of the businesses and how they are changing as well. Then we'll touch upon, what are the different fundraising instruments that are available for businesses, whether it's a startup, whether it's a certain scale and size of a business, but what are the different instruments that are available for businesses today? And taking that into consideration, sure, these are various options that are available in our context, in our geography, but which is best suited for someone like you? Let's evaluate that as well. And just like not one size fits all, even for funding that applies, right? Like it can't, if it works for me, it doesn't necessarily mean it works for your business as well. So we'll look into that. And going into the next subject that I'd like to touch upon for a few minutes is revenue-based financing, which is a relatively newer topic and lesser understood in the market today. So I'll spend a few minutes talking about the who, the what, the why, and the things that Anisha just mentioned. And in the end, I'll take you through a couple of case studies of companies that have used revenue-based financing as a funding option and how it's worked for them, and whether that is a viable option for your business or not. And lastly, just touching upon our company and what we do here today. So one such emerging trend that we do see in the new normal is the rise of the digital consumer. And what I mean over here is, over the last 8 to 10 years, we've seen a drastic shift in consumer consumption and behavior both. And as a result of that, the businesses have had to adopt and have had to take their traditional businesses, which may have been offline formats, to service their customers, which are adopting to newer trends, in order to be able to service them or be left out. They've had to adopt to a digital world as well. We've seen a 6x growth in the size of the market from 2014 to 2020, and we're only seeing it go up multifold over the next decade. And a lot of traditional businesses, whether they are your milk delivery services, which are now subscription services, whether they are your streaming channels, which are now on demand versus, what you would get as a cable earlier, whether there was going into a mall and now going into setting up a storefront on an Amazon marketplace, whether it was spending on hoardings earlier, but now spending on ad spends on social media platforms. All these are trends that we're seeing as changing. And that's what we see over here as well. As a result of that, digital businesses like yours are also having to have to make a shift in the way they deploy their capital in order to fuel their growth. There's a long-term survival and there's a short-term growth. Which one should you focus on, right? And with businesses having to spend on an average anywhere between 10 to 12% of your monthly revenue on marketing, going up to anywhere to 25 to 30% during festive months, that really takes a toll on the company, right? So in order to keep up with these short-term gaps and heavy expenses that the company does have to incur, a lot of companies have had to dilute equity too fast, too soon, in order to scale and in order to spend money. So an interesting stat over here is 40% of equity money goes directly towards Facebook and Google. So that you're saying that 40% of the equity money that you've taken has gone directly towards, you've donated towards Facebook and Google. Is there another option here? Is there a way that we can spend this money smartly? We'll circle back to that in some time. The other trend that we do see in this year, post-COVID, has been the funding winter. I'm sure you all have read about it in the papers today and every day as you see news year on year, where there's a huge crunch in equity capital that is being deployed to fund startups and companies in early stages. The number of deals that did take place this year have dropped significantly versus if you compare year on year against last year. Investors are now taking much longer in their due diligence process to be able to evaluate each company, right? Yeah, you've read in the papers, a lot of IPOs have been, called off because the valuation isn't the way they presumed it to be. There's a lot more, by the time the money is hitting the bank, it's taking a much longer cycle than what they imagined it would do. So businesses have had to relook at a lot of the money that they thought is coming their way, but it may not be actually. So there is a big strain that companies and businesses which look like they were on a high trajectory are also facing and encountering today. So whilst it hits them, it's hitting everyone in the it's a rippling effect, and it's hitting everyone in the ecosystem. So these are the two broad trends we've seen. One is that the consumer pattern has gone digital, as a result of which businesses have gone digital. The second is we've seen the funding winter. There is a crunch of equity capital available in the market today, which requires us to reevaluate how we want to sort of grow our business. We got to look at the evolving nature of the ecosystem, the market landscape here. We got to see whether yeah, sure, I may want equity capital, but is there equity capital available for me to be funded? We got to look at that as well. And then we got to weigh the different options that are there on the table for us and whether that works or not. So let's not spend any time. Let's look into that. So what are the different fundraising instruments that are available for founders today? The two common ones that you've heard of probably are equity or venture capital, and then there's the debt and loans from banks and NBFCs. Let's talk a little bit about each of them, right? Like, what are the pros, what are the cons, what do you see, what do you not? In case of equity capital, it is definitely helpful in an early stage of a company, especially when you're trying to create something new, which is just in its idea stage. It's a great option for product development or to build a minimum viable product and launch it into the market. It helps to get the first few customers in and to find a product market fit. But you have to do it by giving some part of your company. You have to give a share of your company to an investor or to an equity and venture capitalist to be able to take that bet in your company, to be able to allow you to spend that money, to be able to take that from ideation stage into an execution stage and actually launch a product, right? There may be no obligation to repay that capital, but there is the pressure that does come from having somebody else on your cap table. So it's good and bad both. It does come with its share of pros and cons. There's definitely that. Depends on what you want for yourself. And opting for VC funding, it's giving away a part of your company, right? Let's take the example of a Zomato. Zomato has, the founder, Dipinder Goyal, has grown his company over time. And by the time he IPO listed, how much stake did he actually hold? He held 5% of the company. So a major chunk of the company was owned by VC. So who's the one that benefited the most out of his IPO listing? Were all the equity or capital investors, not him as much, right? And going into debt and loans, if you may, or what you've heard of, and through banks and NBFCs. So asset-light companies, they do have access to debt, but you know the drill when it comes to banks and NBFCs. They need a minimum of a 3-year. You have to have, your business has to have been in operation for a minimum of 3 years. You need to have some sort of security or collateral to give them. Often you have to provide them with a personal guarantee. Sometimes you have to provide 100% securitization of an asset, which could be an underlying asset like your own personal first home or something like that. Not really possible for a lot of founders today, which then makes it extremely difficult for a company which has huge potential, but is not able to raise that sort of capital. And again, there's a fixed obligation for repayments, which also makes them very restrictive in the way they are able to structure the contract. So there's between both these, there's a new variant that has emerged, which is a flavor, which is a little bit more flexible from both aspects, which takes a little bit of the good of equity and the good of debt and combines it together, and that's called revenue-based financing. So it allows you to have a more long-term this thing, but it's less restrictive, it's more flexible, and that's revenue-based financing. I don't know if all of you would know what revenue-based financing is, so let's spend a little time looking at what is revenue-based financing. So a significant portion of businesses have seasonality in their sales cycle. You will see a good month when during your festive season, and then there'll be some low months. Each business has that, right? So in case of revenue-based financing, what happens? You get a lump sum of capital up front, and the repayments are a percentage of your revenue across the months. There's a flat one-time fee which is taken, and that's very simple. So there's your capital that you've gotten plus the flat fee. That's it. So the company knows exactly what their outgoing looks like, right? There's no equity dilution. There's no personal guarantee. There are no warrants. There's no strings attached, if you can say that. So in this illustration over here, I'll take you through the example to be able to explain it a little bit better. So what we're talking about over here is a company which was given a 30 lakhs of revenue-based financing with the repayment terms of 10% of revenue share. The capital was deployed in early Jan, and we're looking at the company's sales across the months of Jan through August. We see that in the first month, this company made sales of about 43 lakhs, where in the percentage of repayment, they had to pay back 4.3 lakhs. In Feb, the sales dipped with the number of days that are there in Feb, and maybe the sales cycle too, based on the nature of the business that this company does, as a result of which they only had to pay back about 2.5 lakhs. And then going into June, where sales increased and they were able to pay out a larger portion. So and this could go on up to so there is no fixed tenure over here. There's no fixed repayment date. It goes on according to your future revenues, right? It's a percentage of your future revenues. I am hoping that this slide has made it slightly easier for you to understand what RBF is. I'll just move forward. So the why, the use case of why revenue-based financing helps, right? It would be best used for when you can map an input to a predictable output. What do I mean by that? It needs to be measurable, okay? So for example, I can use it for things like performance marketing, vendor financing, vendor payments, inventory financing, working capital needs, all of these. So what I mean by that is for every dollar that I spend on marketing, am I able to make $2 in sales? That is predictable input. I'm able to see how much I'm putting in. And then again, I'm able to see how much I'm getting out of it. That's what helps to be able to see that. So you want to use revenue-based financing for things like that. I want to know that if I'm paying my vendors this much, against that, I'm able to churn my working capital these many times over. I'm able to churn it 6 times in a given year. I'm able to churn it 8 times in a given year. That's what I'm looking at understanding. The who, the businesses that we work with, right? What businesses would revenue-based financing be apt for? What would it, entail? So any business that has a recurring revenue, any business that has already started generating revenue, it's in a revenue generating phase, and it has a minimum revenue of say anywhere from 2 lakhs to all the way up to 15 crores, right? What categories would fall under revenue-based financing? Here, I want to say that it's a wide field, right? Like there's plenty of options. It's all India. because it's a digital first approach for us, as long as there is online sales, it's fine. As long as it's an e-commerce brand, it could be in fashion, it could be in footwear, it could be in apparel, it could be in cosmetics, it could be in edtech, it could be in subscription-based services, whether it's a gaming service, whether it's a streaming service, it could be goods like products like your F&B segment, it could be in your FMCG segment. Any such businesses, it could be an operating marketplace where they are selling by collecting multiple sellers onto their platform. Any businesses that have an online presence that are making sales online. I think that we today service a large variety of categories within the ones we work with. Now touching upon the how. So how does revenue-based financing work? I did give you a small snippet about how it worked in the previous example. Here I've taken another example to be able to explain it to you slightly better. So imagine a scenario in which a founder is given 50 lakhs of capital, and GetVantage will help you deploy it across your ecosystem partners. In this case, it could be an Adyogi, for instance, which is managing your performance marketing for you and allows you to manage your spends and able to track your return on ad spends for every dollar spent on, say, Facebook or Instagram or Google spends, any of that. And then through the insights tool that we provide, you're able to access and see how the capital that you have deployed is actually performing for you against the sales that you are What you see on the extreme right is, for in this case, in the previous case, the example of percentage of revenue share was 10%. Over here in this example, the percentage of revenue share is 5%. So for every 100 rupees earned in revenue, 95% would go back to the company. 5% would be collected as a repayment towards the capital deployed by GetVantage at the initial stage to you to be able to grow your business. Yeah, and the deal structure, what are the criteria that we primarily look at? It could be the amount could be anywhere from 5 lakhs to 5 crores. There's a fixed flat fee which is taken up front. It varies depending on the business and this thing. There's a spectrum over there that I've put up. The repayment is also a percentage of your revenue. Again, that can be structured. So you have a fixed cost of capital that isn't changing for you. So in this case, what I can tell you is assume that the fixed flat fee is capped at 10%. You have been deployed 50 lakhs of rupees. Against that, you have a 10% flat fee, which is 5 lakhs. You are paying that 5 lakhs upfront, or at the end of the tenure, all you have to pay is 55 lakhs, or you pay the 5 lakhs upfront and you pay 50 lakhs across the duration of your tenure of when you against the sales that you are making. So it's very simple, no interest rate, no confusion, none of that linked to it. Very simple model. So until now, we've covered the different instruments for raising funds. And now the emphasis would be on which one is right for your business, right? Like, where do you see yourself? It totally depends on the stage of the company that you are at. Are you in a pre-product market fit, or are you in a post-product market fit? If you're in a pre-product market fit, that basically means that you're making little or no revenue. It could be in an ideation stage. It could be at an incubation stage. That demands speculative capital. That demands that people fund activities where the input is not well defined to output. I touched upon this a little bit earlier, where I talked about how input and output is measurable. You can predict your input for every dollar spent against the output that you do receive. Here, I can't do that in a stage where revenue is already not coming into my company. That would be, for example, launching a new product, it would be for R&D expenses, it would be for salaries. I can't map exactly against an output. In this case, I would want to look towards peers like friends and family or incubators and accelerators to be able to fund my business. However, if I am a post-product market fit company, that is, I already have a product that is launched in the market, which is already selling itself. But say I want to venture into foraying some new product launches, or I want to foray into some newer markets. I have a recurring revenue stream, but I want to grow now. I want to double down on my current trends. Then I need that sort of, I can access capital where there is that predictability, where I can map it against the input and the output. And that could, there I could look at a revenue-based financing option. I could look at equity capital. A bunch of options are available for you as a business. So by founders, for founders. We've gone through the different fundraising instruments, and we've also seen the scenarios in which it could be the right fit for your business, whether it's an early stage company, whether it's a company with already has a product launched in the market. Depending on where you are at in your growth stage, you know what are the options that are available for you. Now, through the last couple of slides, I hope that it's clear what RBF is here. Just building onto that, I'd like to take you through some of the case studies with some of the portfolio brands that we've worked with and help them unlock value. In our platform at GetVantage, there's founder-friendly capital, which is there's no dilution of equity. Through the platform, once the capital is deployed, you're able to log in and you're able to see the money how your money is being spent against your revenues that you are earning and against the marketing spends that you are making or your inventory costs or your regulatory payments. There's an exclusive partner network that I will touch upon very shortly right after this, as well as the founder network. I'll talk about them both to you right after this. So a couple of case studies that I have taken up over here. So just to give you an example of how RBF has worked in certain brands. So over here I have Rage Coffee. It's a popular coffee brand which is digital first, and as it's at the forefront of the coffee industry in India today. There seem to be a lot of new coffee brands coming up, but this one ranks high up there in terms of brand recall value. And they were looking for, they wanted to launch newer products like their cold brew, etc. They wanted to enter into newer territories and markets within India. And for that, they were looking for capital. With the help of RBF, they were able to boost their capital by 350%. As per what the founder had, you can see what the founder has to say, able to help, looking for smart investors, helping you within your CapEx. Another such company that we've worked with is a popular apparel brand, which you all might have seen on Shark Tank. It's a company called Urban Monkey. It's a new funky company with unisex clothing for streetwear brand for the younger Gen Z, I would say. And it was seen on Shark Tank. A lot of sharks wanted to invest in this company, but the founder refused all the offers that were on the table because he wasn't happy with the valuation that they had to offer. As opposed to taking the Shark Tank equity money, he opted for RBF, and he was able to see a 4x increase in his sales, and extremely happy. He had a call out on social media as well, explaining how without having to dilute equity, he was able to grow his business very quickly with the help of smart capital like RBF. Another such company that we worked with is a tonic company called Jade Forest. This is an interesting one because they looked at, when they did look at raising capital, they did a mix of equity as well as revenue-based financing, and they were able to deploy their capital smartly. They used equity for salaries, they used it for new product inventions, etc., but they used the capital raised through the RBF route for their marketing spends and their working capital inventory needs. As a result of which, through the 2 years that they have been associated with us, they've seen a more than an 800% boost in funding. And again, there's a small testimonial from the founder. So just, I think, largely talking about the global landscape and how revenue-based financing is even on the rise within India. Those were just, whilst I touched upon some of those companies, those were just a few of the brands that we've fueled in their growth stage using RBF. But there's a continuous trend for a growing, burgeoning rise of entrepreneurs, both in India as well as across the globe, who opted for founder-friendly capital, realizing that there's a tip-off point, which is the right stage at which you want to have an external investor come into your cap table, vis-a-vis actually having to grow on your own terms, the way you want to grow, without having to dilute any equity, right? And globally, it's projected that RBF will be 42,000 million in capital deployed, with a staggering growth rate of 61% year on year from here on out. Lots of news and noise in lots of articles across the globe and locally, talking about RBF, talking about players, companies that are raising non-dilutive capital. If you just Google it, you'll see plenty of articles. Even in India, we're one of the pioneers having done this, but plenty of other players already there supporting this ecosystem and helping businesses in India grow as a whole. So I think we're poised rightly to be at the right stage to be able to grow today. I touched upon this very briefly earlier, and this ties right back into the session that I'm having with you all today in collaboration with Adyogi. The masterclass that is being conducted here today is similar to what ties up very well with the Founder for Founders network that we've built out. So we have a strong relationship with our strategic partners like an Adyogi, and along with our portfolio brands that we work with, whether it's a Rage Coffee, whether it's a Jade Forest, or any of the ones that are there today, we work with 300, 400, 500 brands. So a lot of the founders are part of this ecosystem. A lot of our partners are part of this ecosystem, where we're able to collaborate together. We're able to come together, help each other with learnings, with mistakes, with hires, decisions, mentor programs. There's a whole bunch of things that we are doing. And this is just one platform, which is over and above capital. You want to be able to provide smart capital. So this just builds a community around it. And that's what we're doing over here. And other than the capital that is deployed, there's this entire rewards program that you have access to as soon as you become a part of our ecosystem. We're thinking about a business as any business today which wants to be digital in nature is going to want to have access to a few basic tools, right? I need to spend money on performance marketing. I need to work with an Adyogi sort of person, because I don't know how to spend my marketing money. I need to work with somebody who knows exactly how to manage it for me. I need to work with, I need a payment gateway so that I can actually sell online. I need to know how to do that. I need to, so think of a Stripe, think of a Razorpay, think of a PayU, Paytm, any of those. I have a sales pipeline. I have no idea how to manage it. I need to be able to use a CRM tool. I need to be able to see my pipeline. I'll use tools like a Salesforce, a Pipedrive, etc. I need to host my website on the internet. I need a space like AWS. I need the IBM cloud. I need Microsoft cloud. All of these are available at heavily discounted pricing because we created these partnerships in place. We're thinking about any business which is going to be digital, which wants, so will need access to some of these subscriptions and tools. And we've gone out there and we've created these partnerships, and we're offering these for our portfolio companies. So that's largely it from my end, and thank you for attending and being a part of this session today.
Thanks, Sneha. That was so insightful. We would now open the room for questions. To all the attendees over here, feel free to drop in your questions on the Q&A section on the bottom tab of your Zoom bar. We have a couple of questions in the back end. most of which, Sneha, you have provided enough clarity on. But if you could do a summary revision of it, question number one is, what is revenue-based financing? We would be glad if you could help our audience with some background.
Sure. So think of revenue-based financing as capital you need for your business. You don't have, say, your business is making, so your business is on maybe at 10 lakhs a month, 20 lakhs a month in revenue, and you want to now take it up to 50 lakhs a month, a crore a month, right? But you don't have the capital to be able to do that. How do you do that? You want to think of, you have a few options in front of you. You can either access equity, you can by going out to angels, VCs, PEs, all of those, and you say that, hey, this is my business. I think, this is what I have to offer. I'll give you some equity in my company. Why don't you take some equity of my company in exchange for that? Give me some money. Or you may go to a bank and you may tell the bank that, hey, I need a loan, for which they'll take a security or an asset because your business may not be that long in business. And you may have to provide some sort of personal guarantee. Or you may consider revenue-based financing, which is you get a lump sum of capital, again, looking at your underlying data points. And those data points would be things like, let me just show you.
Got it. Next question is related to the first question. It says, how is revenue-based financing different from other modes of funding? So would you like to answer that too?
Yeah, sure. So a bunch of differences. There's it's non-dilutive, so you're not giving up any of your equity share in your company. It is, I touched upon it earlier, but basically to say that there is even on the debt side, right? Like you don't have fixed EMIs to pay back. You don't have to have any sort of security or securitization of a fixed asset against it. You don't need to provide a personal guarantee. So none of that comes into question when it comes to RBF. It's no strings attached in that sense. As long as your underlying data points are strong, as long as you're able to connect your marketing portals, you're able to connect your payment gateways, you're able to connect your storefronts or your marketplace information, and your regulatory payments that you are making, you're able to do that through RBF.
Thanks, Sneha. Vikas Chaturvedi asks us, we are an early stage startup in e-expo marketplace without any traction. We can get BF. Would you want to answer this too?
Sorry, can you repeat that?
We are an early stage startup in e-expo marketplace without any traction. We can get BF. Vikas, it would be better if you provide more clarity on this question. Next question is from Kumar Jayant, who says, what if BF here stands for business finance, Vikas says.
So again, I mean, if you are not in a revenue, if you're not making revenue month on month, you're not PAT positive, then revenue-based financing is not an option yet. But if you are in an incubation stage, you're still ideating, your website isn't live, you're not selling anywhere, those are not businesses that can be funded through, because the underlying thing is the funding is happening based on your future revenues, right? You're looking at past behavior of revenue trends and you're predicting future revenue trends and you're deploying capital against that.
Got it. Kumar Jayant asks, what if we just started and we are in our ideation stage? How do we raise a small amount like 2 lakh fund to execute the idea?
By approaching friends and family. I think that friends and family round would be your best bet, or you could look at some incubators, accelerators as well. There are lots of those out of universities and even corporates which look to fund, in-house companies, and as long as they have some sort of synergies.
How has the growth of GetVantage been over the last year? Have you seen any emerging trends?
Yeah, so thank you. I mean, very interesting. It's been exponential, to say the least. We've seen a burgeoning rise in e-commerce brands that have come through us or through the system. We've looked at over 6,000 to 8,000 businesses today. And it's just about getting started. So I see the digital landscape just about evolving and just getting started. You saw the stats that were on there. You're looking at 10 million businesses being online by 2030. So when I talk about 6,000 or so, that's just a small fraction.
That's very lovely to hear, Sneha. We have one last question. Can you talk about some of the brands in your portfolio?
Sure. So I've already shed light on a lot of our, some of the companies that are working with us and have worked closely with us. I talked about Rage Coffee. I talked about Urban Monkey. I talked about Jade Forest. All of those are portfolio brands that we work with. We've seen a large portion of our businesses as e-commerce businesses, and in various verticals, whether it's beauty, wellness, footwear, apparel, edtech, across the board. And then we are seeing a strange but interesting rise in subscription-based services. So a lot of subscription-based services, think milk delivery, think gaming services, think streaming services, all of those, like think of HR portals, which are offering you an HR portal for your startup. All of those are recurring revenue businesses. So subscription-based businesses are also on the rise.
Understood. Got it, Sneha. With that, we have come to an end of the masterclass. Thank you so much for providing us insights on how do we get funding in the new normal. Because we have some very patient attendees sitting by with us since the beginning, we have some freebies for all the attendees over here. Sneha, if you could allow me to present the screen.
Sure.
Let me know if you can see my screen.
Yeah.
We do. Good. Yeah. So we have special attendee offer. We have special 50% off on Adyogi managed and self-serve platforms for first 3 months. With a monthly ad spend of 5 to 7 lakh, Adyogi fee is 15%. 7 to 15 lakh, 12%. 15 to 30, 10%. 30 to 78%. 70 to 30 again, 6%, and more than 3 crore, we have 4%. And we'll all get a free copy of our latest e-book on how to build a 100 crore e-commerce brand. Apart from that, we are all getting the recording of this webinar. So I think a lot of takeaways for all the new joinees. So that was pretty much it. Thank you for joining to all the attendees over here. Thank you, Sneha, once again for taking us through the insights. So that's pretty much it. Thank you, everyone.
Thank you, Anisha.